I would like to call our panel up, and we don't particularly have any order on the stage, but I'm going to ask our moderator to come up first. You know, none of these people need an introduction, but Manny De Zarraga is our moderator extraordinaire. He's the executive managing director of JLL Capital Markets and a U alumni. So Manny, pick a seat.
Oh, you want to sit down?
I want you to sit down. I mean, you have a mic on your seat, and then I will just, go in the order that people are sitting here to ask the other people on our panel to come up and just, pick a seat, any seat. I think we have enough for everybody. Edgardo Defortuna, Fortune International founder, CEO. Warren de Haan, Acore Capital founder, CEO. I'm going to get tired of saying that as I go across these rows. Tere Blanca, CRE founder, CEO. Malcolm Butters Construction and Development, founder, CEO. Michael Comras and Company, founder, CEO. This is pretty cool. Michael Sommers, Grand Peaks, Senior Vice President, alumni, incredibly engaged alum, and Neil Shah from Hersha Hospitality, also a CEO and founding family member. So now I don't belong on this stage. It's their stage.
So, and Andrea, we have, an hour? Okay, thank you. All right, well, good afternoon, everybody. I'm Manny De Zarraga, as Andrea mentioned, and I am going to get a new selfie photograph because the photographs of all these people are so much better than mine. I mean, they're like super pro.
I'll need new pictures.
Yeah. I mean, you guys look sharp. So anyway, this is like a really sharp group, really, really smart group, very, very successful, mostly all primarily CEOs. All of us, pretty much, are members of the University of Miami Business School Real Estate Advisory Board. And we get together a couple times a year. And one of the best parts of us getting together is for us to talk and to hear from each other as to what we're seeing in the market, what we're seeing in the business, et cetera. So that networking is of great value, and hopefully you'll find it also great value, the discussion we're going to have here today. I have not given anybody any of the questions. When we all get together, it's totally unscripted. I invite any other panelists to challenge the other panelists if you don't, and we have Father Michael Comras here dressed all in black, which is great to have him here. So, but anyway, I think, one thing is, I think all of us that are up here are very curious, and we're always looking to learn because there's always all kinds of neat things happening in our industry in so many different ways. And I think the best example of curiosity that I always tell the analysts in our firm is a guy that I met, which I think he was a senior analyst, and he was working for a large apartment investment company, EQR. And this fellow told me, every weekend I buy a ticket on Spirit Airlines for $19, and I travel around the country to go visit apartments that our company owns. And I go, wow, that's amazing. Like, so you get out there and go see the market. No one's telling you to do it. And he's actually sitting right here. That's Michael Sommers. So anyway, so hopefully what you hear today will spike your curiosity. So anyway, to get started real quick, you probably know all these titles and CEOs, but maybe I'd like each one for a minute or so tell you what they do. And I'm also going to ask you to tell them what you thought you were doing when you were in a room like this at a university, what you're going to be doing in your career later on. So with that, I'll go Edgardo.
Hi, good afternoon. I'm Edgardo Defortuna, President, CEO, and founder of Fortune International Group. We are a development company, a marketing and sales organization that sells development projects, and a brokerage company that has 14 offices in South Florida with over 1,000 real estate agents. And we specialize in residential properties. 70–80% of what we do is condominium residential, very high end. Presently doing St. Regis residences, 2 80-story towers, and Ritz-Carlton residences in Pompano Beach, Ora by Casa Tua on Brickell. So we really focus on very high-end residential, but also represent all the major developers in town in the marketing and sales of their projects. throughout South Florida. What I was doing when I was sitting in that chair, actually, it's funny that you asked, because I started my work when I was in your chair. I figured out that the typical broker wasn't concentrating in Latin America or paying attention to the potential Latin American buyers. So I said, there's a niche there to really explore. So I started going down to, I'm originally from Argentina, so I started going down to Latin America and educating people on how easy it was to buy real estate in Florida, and really created a lot of relationships that later on helped me in developing my investor base and all my clientele. So I really had a passion for it, and I loved to be in the University of Miami because it was the right place at the right time. And I think that today I can say the same thing for all of you. I mean, Miami is really, we promote Miami all the time, and every time we say Miami anywhere in the world, people really gravitate to us because everybody wants a little piece of Miami.
Great. Thank you. Warren?
Hi, good afternoon, everyone. My name is Warren De Haan. I'm the CEO and founder of Acore Capital. Firstly, it's a privilege to be here today. I'm and my family are a recent transplant from Los Angeles to Miami, and it's been absolutely exceptional to be here for the last 18 months. The people, the energy, this institution, Andrea, the folks that work here, and the positivity that you are all experiencing, you should feel very fortunate to be in the seats you're in today. I don't think you quite understand yet how great the outlook is for you coming out of this institution and also being in this market. So hopefully we as an organization can contribute more towards your future. Acore Capital is one of the largest commercial real estate lenders in the country. We manage about $20 billion of assets. We have 120 people, and so we're a lender. Recent projects we're doing here is the Shore Club in South Beach, the Four Seasons in Surfside, the Four Seasons in Palm Beach, among many others. We lend on projects to all these developers and so on that build beautiful projects, and we do everything from office buildings to apartment buildings to hotels, industrial, retail, all across the spectrum. We have about 120 people, and we'll originate between $7 and $10 billion a year in loans. When I was in your seat at university, I didn't have the opportunity to come here, but prior to that, I was working in a hotel in London underground, and then got an opportunity to go to university in the United States, and that set me on a path to go and work on Wall Street. I think at the time I was earning about £13,000 a year, and I realized that I wasn't really going to get where I wanted to in life until I went to a great university and I got the opportunity to sit sort of where you are. And my particular path was I really wanted to get onto the ownership side or the finance side of commercial real estate, and my path took me to Wall Street, and hence I got the opportunity to finance most of the big developers and the medium-sized developers in the United States. So that's created a tremendously interesting path for me. Financially, a tremendously interesting path because I deal with very interesting people, from the brokers, the leasing brokers, the mortgage brokers, the investors, the borrowers, the developers every day, and I get to see what all these very clever people are doing and participate in their lives.
Tere, thank you. Great job.
Hi, everyone. Tere Blanca. I am the founder and CEO of Blanca Commercial Real Estate. So I started the firm about 15 years ago in April of this year. So I say that we're teenagers, and prior to that, I spent about 6 years leading a global firm here in South Florida, also in commercial real estate services, and 14 years prior with a developer, where I really learned the business from the ground up. Our business is the services business. We're here to serve our clients. Pretty much everyone around this table, other than perhaps on the hospitality side, could be our client or has been a client. And we're a team of 47. We focus in office leases for representing owners of office towers, business parks, and we also represent companies that need office space to operate their business. And if you've heard that office is a thing of the past, please don't take it seriously. Office is here to stay because we are social animals, and in order to learn and to collaborate and to expand our businesses, we need you in the office. So, what is that saying that they say? If you're not seen, you're not going to progress, because out of sight, out of mind. I remind all of you, it's important to participate in the office, be present, to learn and to grow. We close about 2 million square feet of office leases every year, so we are fortunate to deal with a lot of different companies across industries, and that's one of the things that I love about our business. We get to learn about, manufacturing businesses or banks or law firms or private equity businesses, because for us it's important to understand what our clients need to be able to satisfy their needs for office space. And it's a really exciting time to be in Miami for office. We're an anomaly. You'll hear a little bit more about that. A lot is happening for office here. So when I was sitting where you are, I will say I'm a great case study about the fact that your career takes a lot of different paths. I thought I was going to be an engineer, so I started here at UM in the engineering school, and I spent 2 years studying electrical engineering. And one day I woke up and said, I don't think I want to do this for the rest of my life. So I ran to the business school and then finished my undergraduate here. And I thought I was going to be in banking. I was following in the footsteps of my grandfather. I worked in banking for 2 years. I didn't like it at all, so I ran back to school. That's where I met Manny for the first time. We were colleagues in the master's program. And then I was very fortunate to fall in love with commercial real estate, and I've been in this business now for over 35 years.
Great. Thanks,
Thank
Tere.
you.
Hi. On? I
think it works.
Hello? Can you hear me? Oh, maybe. Thank you. I'm Malcolm Butters with Butters Construction Development. I'm the CEO and founder of that. My brother and I started that firm about 34 years ago. And we're a vertically integrated real estate company. So what that means is we do construction, we do development, we do property management, and we do leasing and acquisition. Our specialty is primarily industrial. We do office too. We get to work with terrific people like Tere. And we are probably the largest or the second largest or most active industrial developer down here in South Florida. So industrial, not everyone might know what that is or what's involved because you don't see it every day necessarily, but just think Amazon. So I think nobody really appreciated industrial until the pandemic came, and then everybody started ordering everything online, and they started understanding a lot more about industrial. I was a student, just like you guys here, 1978 to 82, and I graduated like Terry and I think Michael from this very great institution. I think you guys are very, very fortunate to have facilities like this. We did not have these beautiful facilities back in those days, and we didn't have great panelists like this every day. When I was at this school, a little bit about us too. We do probably about 2 to 3 million square feet a year of industrial, and we've won the Developer of the Year 7 times over our history. We were, when I was sitting in this great university like you guys and take the university serious, like I tell many students, you know, if you don't have to go to Harvard. Andrew's heard the pitch a million times. You don't have to go to Columbia. The University of Miami turns out as many and better students than any of those institutions. And a number of us panelists are good examples of that. But there's tremendous, tremendous opportunities in this university. So when I was here, I was in the business school, and I didn't really have a clear guidance and wasn't going to go into real estate, but I thought business would be good. Somehow, for some reason, in my second year, I said, you know, maybe I'm going to become an architect, because my family was in real estate, and I could design buildings for the family, etc. Went in, I got accepted to the School of Architecture, realized I can't draw. That could be a slight setback. We didn't have CAD back then. You had to use your hands. And so immediately, back in my junior year, came right back here to the University of Miami and the business school and graduated with a degree in finance.
How's that?
Nope.
Easier. Hi.
Is that on? Yeah.
Can you? Okay. Hey guys, I'm Michael Comras, Comras Company. I started the company down here about 30 years ago. We specialize in retail development and leasing. We represent tenants and landlords throughout Dade, Broward, and Palm Beach County, and then some around the country. Generally, that has led to the development business, where I've developed and acquired properties in many of the places where probably some of you guys like to hang out, like Coconut Grove or Lincoln Road in the past, or Midtown and Wynwood and things of that nature. So we do a lot of work in the areas where most of you guys want to hang out. I went to school here and was in Andrea's first year of teaching. So I have a lot of history, and Andrea reminded me how I used to sit in the back of the class and lean my chair back, because I was the back. You're either the front of the class student or you're back of the class student. I was totally the back of the class. But it was a great experience. I knew when I came down here, I wanted to end up back in New York and live and work in Manhattan and really understand real estate up in Manhattan. And after 10 years of living and working, I was about to have my first child, and my thesis was I didn't want to push a stroller through the streets of Manhattan in the middle of the winter. I said, I'm going back to Miami. All of my friends, and when I was in my early 30s, all my friends looked at me and they said, you're out of your mind. You're leaving Manhattan now? And today they look at me and they say, how did you know? 30 years later. And I'm like, listen, it's all about being down here and enjoying that quality of life and the experiences down here. And, I used to sit in the class and think about how I was getting to the beach. But it's been a great opportunity, and being on the board, the Real Estate Advisory Board, and sitting with this crew and having these sessions where we were able to, just talk about current events and what's happening and what we're really working on has really become the best part of our get-together. So I'm glad we're able to share that with you guys.
Good evening. My name is Michael Sommers. I run the East Coast for Grand Peaks Properties. We're focused on the apartment industry, both buying and building apartments. I think part of what really attracted me to real estate is if you think about your life, your parents' life, what do you spend most of your money on? Even a law office, maybe the first expense is payroll, the second expense is the office space. The same thing for a doctor's office, the same thing for a household paying for their house, as well as paying for their children to be fed. So it's always something where I knew that was a big draw of capital out of families' budgets, and rather than being a salesman of a million things, I said, what can you sell 5,000 times over for the highest price possible? I think when I look back on my time at the university, I graduated about 20 years ago, and the first thing I was hired to do was to go work for the owner of the Burger King in Brickell. The Burger King in Brickell is immediately across the street from Brickell City Center, and you say, why is there not an 80-story tower on that building? Well, Burger King had a very long lease where Burger King had the right to operate a grocery restaurant in that corner, but they sent me out to study what would condos on that site be worth, and I went out and studied 140 different condo buildings that were being developed the summer of 2004, and it really got me curious to go out and see and understand the market. And when I think about the apartment industry, it's a fundamental need. Until people are literally going to sleep in a dresser like Kramer had people living in his dresser on Seinfeld years ago, having durable space is really of value. And I don't know if Google is a car company, a phone company, an advertising company, and I have no idea what they're going to be in 7 years. I know a well-located, well-maintained apartment community in a major city like Miami is going to be 90 to 96% occupied year over year. Rents may go up 7%, they may go down 5%, but there's consistency of cash flow, and a lot of the pension funds and insurance companies, family offices that invest with Grand Peaks look for that consistency of income, and we look to find opportunities to deliver where we can manufacture returns by maybe renovating a property that had been neglected, doing things that other people hadn't invested in to make a better property that ultimately achieves higher rental cash flow and appreciates over time.
Dr. Neal.
Everyone was pressing the button.
I did not press
You
the
didn't
button.
press that button, it worked, and this works, okay. My name's Neil Shah, CEO of Hersha Hotels and Resorts. Today we are a privately held owner and operator of hotels and resorts. We focus primarily on luxury and lifestyle hotels. You're saying that real estate is great because it's been around forever. Lodging is the same kind of thing. We sometimes think of hotels as real estate, sometimes we think of it as an operating business, but people have been traveling forever. From the earliest points of time. And what we love about this business is that increasingly people are valuing these experiences that you get from travel and the stories you get from traveling, even more so than their home and their office at times. So it's an interesting business to be in. I've been in it for over 20 years. I said that today we are a privately held company. We were a publicly held real estate investment trust until just November of last year. And so we went through a M&A transaction and are now a privately held company. But across the last 20 to 25 years, I've been focused in the hotel business. We've been owners and operators of different kinds of hotels over the years. We started with small motels, went into limited service properties over time, and then more recently into luxury and lifestyle. When I was in the seats that you all are in, I grew up in the Northeast, and I only moved to Miami about 6 or 7 years ago. And I'd always heard about University of Miami, but I only got close to it since I moved here. And as Warren mentioned, it's been really important for us for me, to get to know this community, because it has been, it's one that gives us a lot of excitement about this marketplace. And for me personally, it's helped me to get very connected here in town. But when I was on the other side of this, this room, when I was growing up, my family had gotten into the motel business, and we had some small properties. I grew up in a 16-room property and then a 20-room property, and my brother and I, we used to kind of help around, like it was kind of like a family farm, but you were cleaning rooms and you were helping in the laundry and things. And over the years, we kept growing that business. But when I was in college, we were still a relatively small group. We had 4 or 5 properties in central Pennsylvania. And what I started doing when I was on this other side was just reading as much as I could about the industry, learning as much as I could, talking to people in related industries, because at that time hotels still weren't really thought of as real estate as much, but I started to get to know the real estate market. And then I went off and did other things. My brother and I I was in management consulting, my brother was an attorney. And then 5, 7, 8 years later, we came back to our family's business to help grow it and scale it from small town America, smaller properties, into major metro markets. And that's something else that all real estate really offers, that kind of mobility, because it is kind of a people business in the end of the day.
Great job. The comment Neil made about a people business, collectively this group, many of us have been friends for maybe 25, 30 years, and we do a lot of business together. So I'd say, because we do a lot of business with Acore, et cetera, we're probably collectively maybe a couple $2 billion of business that we do as firms. And by the way, on a side note, Neil sold his REIT for $1.4 billion, so that helped, although we didn't have an opportunity to do it. But
Neil's looking really relaxed.
So the people around, they're sitting next to you, are the ones that you're going to be with up here probably in 30 years. So anyway, so people and debt are 2 important parts of our business. And every day we open the Wall Street Journal or the Financial Times, or I looked at an email when I was walking in here, the debt drives our business. So I'm going to turn it over to Warren De Haan, who is truly a global player on the debt side of the business. And I'm going to mention, before you get started, that I received a text earlier today that New York Community Bank is expected to fail before the end of the week. So,
You got any other good news?
But there's a big debt market out there. So Warren, go ahead.
Yeah, so a couple of quick observations. I think the first observation is that we're all sitting in Miami, which is actually the most productive, the strongest market in the entire country. What I want you to leave with is the rest of the country is not Miami. Okay, so spend your time reading things like the Wall Street Journal, the New York Times, the Economist. Get off of your iPhone and pay attention to what's going on outside of Miami, because it will give you the fake perspective on what's going on in the economy. Now, the stock market and the economy are not the same thing, and the markets you need to understand a little bit better. The debt markets, as Manny says, drives value. Our business, the value of commercial real estate, is highly correlated to interest rates. Interest rates, literally the cost of borrowing money went from 3% to 8%. So you're all in real estate. What happens when your cost of debt goes from 3 to 8? Your values go down, right? So focusing on the Federal Reserve, Jerome Powell and what he is going to do is going to result or lead us to a path of where interest rates are either going to go up or going to go down or stay flat. We've had a 20-year period of interest rates really coming down, which means asset values have continued to go up. And we've had a tremendous amount of debt liquidity, meaning that anyone on this panel was buying properties, multifamily, at 4 caps, 3 caps, 5 caps, industrial similarly, and hotels a bit wider. The debt markets were enabling borrowers to buy these buildings because the cost of debt was 3. So if your cap rate is 4, you get a positive spread and you're making a 7, 8, 9, 10% cash and cash return. Today, that borrowing cost is going to range somewhere between 5.5% and 9%, meaning that your cap rates have to have moved out as a result of it across the country. Now, in South Florida, there's a supply-demand imbalance, meaning that there's greater demand for commercial real estate than there is supply, and we have a lot of rental growth. So take that out of the equation. But as it relates to the rest of the markets, we really have to focus on the flows of capital. There's about $4.5 trillion of commercial real estate debt that is outstanding in the United States today. About $2.7 trillion is coming due over the next 5 years. Because of what's happened with the banking system and with high interest rates, the amount of the availability of low-cost debt capital is at an imbalance relative to the demand. So we are in an imbalanced situation, which is going to result in less debt available and less cheap debt available for acquisitions. So what's happened is that the investment sales market has stalled out. It's at the lowest level it's been in sort of 5 odd years. I'm mentioning these things because I want you to think about these bigger concepts, the flows of debt capital, liquidity, the banking system. You talked about one of the regional banks. The regional banks make up about 70% of all financing in the United States. Bank financing comes from the regional banking system. And we've seen bank failures. So that is not a good thing for liquidity. The other thing I'll focus you on, and you should read about, are fundamentals. So what are the things that drive demand in commercial real estate? The health of the consumer. How healthy is the consumer? Read about it. Corporate earnings. Are corporations healthy or not? Read about it. And third is government stimulus programs. There's a bunch of about $7 trillion of stimulus. Read about it. I encourage you to read about it. So you have liquidity, the amount of debt available to support the acquisitions at a low level with increased regulation and banks having issues. And secondly, you have fundamentals, which are the drivers of demand. So all I'm trying to do is to have you throw some things into your mind and force you to go read about banks, read about liquidity, and say, oh, that's what he meant. I see what's going on. And one final point is the Fed. So there's a 60 Minutes article a couple of days ago with Jerome Powell. This is really boring stuff. But as you start peeling this back and trying to get context, just listen to that 60 Minutes interview. Very interesting, because it covers debt. It covers the behavior of the US government as it relates to liquidity and where we think interest rates are going. And then fundamental to all of this is, if interest rates come down, we will get stabilized values or increase in values, and that's what we're all hoping to do. So I would encourage you to log on to YouTube. It's on there, 60 Minutes, very interesting Jerome Powell interview.
Warren, one other quick question. I read a report the other day that a lot of students coming out of universities that were looking at going into private equity are looking at going into private credit. Yeah. You want to say what?
Sure. So private credit is the formation of capital, not in the banking sector, but in the non-bank sector. So Acore is one of the biggest non-bank lenders. So our capital comes from insurance companies, pension plans, endowments, sovereign wealth funds, private pools of capital that have been formed that are looking for a rate of return that is safe. So they used to invest in private equity, so folks that were buying companies and everything else, but because of the volatility in the markets and the movements in the economy, these are people that are pensioners, as an example. So the state teachers' pension plan. And they just need like a rate of return. They don't want volatility. So they've moved a lot of their capital from more risky asset classes into private credit. Companies like ours that will then fuel the opportunity for folks like the developers over here to go and buy more properties. So that pool of capital has expanded dramatically, both on the corporate side as well as the commercial real estate side. So that is a huge opportunity for all of you in this room to look at for your careers. And I'll just make one more quick point though. I was recently giving a guest lecture at another university, and to the class, I said, I think you're the luckiest class that I can remember in the last 10 years, or 15 years. And everyone looked at me as if I was mad. The reason for that is the last 10 years have been, everything's been great. We're entering and we are in a phase where there's a lot of workouts, there's a lot of foreclosures, there's a lot of owners that are losing their properties to lenders. The most important thing for you coming out of your university is how much you learn in your first 5 or 6 or 7 years, not how much money you make in those first years. So this opportunity that you've got in front of you is going to be incredible.
100% right. Excellent points. Neil, you had a public company until November of this year, and you are in one of the most volatile industries of real estate, which is your revenues are daily and can disappear overnight. So maybe you can share your thoughts when you went through the pandemic and your revenues went to zero, and having a public company and your perspectives on lodging, et cetera.
Yeah. Yeah, that, you know, I mentioned that hotels are partly real estate, partly an operating business. The real estate, it's obvious that you do have buildings and physical plant and an impact on the built environment, but you don't have the benefit of kind of consistent lease income. But you still need to spend the money on the big buildings and things, but you have a lot of volatility, as Manny mentioned. And so in a market like even as good as Miami has been one of the best lodging markets in the country for, I'd say, for 20 years. And I'd say for the last 10 years, probably clearly the best market in the country. But still, this year, compared to last year, in luxury and lifestyle hotels, in this great market in the country, Miami, our revenues are down probably 15% compared to last year. Last year was a phenomenal year. 22 and 21, no one was traveling anywhere else. You couldn't go to the Caribbean, you couldn't go to Europe. People from all over the country were coming to Miami. But what does 10 to 15% decline in revenue do on your profitability? Because all real estate, you have to maintain the overhead, you have to maintain the building, you have to maintain the people to serve the building. And so lodging has real volatility because revenues can go up and down with pandemics, with recessions, but your cost model generally stays pretty high. And so when 10 to 15% drop in revenue can be a 30 to 40% drop in profit. Now companies, you can manage that, you can have reserves, you can have capital, but then you have a case like the pandemic, and the pandemic, revenue didn't drop by 10 or 15%, it dropped by 80%. In Miami, not so much, but New York, we're very active in New York, Washington, Boston, LA, all of San Francisco, Seattle, those markets, they were down 80%. And so then you were losing money, we were losing money for 10, 12 months. And so that makes it difficult. It makes it challenging. And that's what leads companies to sometimes look after kind of more permanent source of capital. And so we had gone into, we were a private company in the 80s and 90s. We were a very small business. And then in the 2000s, we created a public platform. We continued to have some other private businesses, but generally we created this public platform to help us access capital that's a little bit more permanent, and you can access it. You can continue to raise capital when you need to. And so we were able to get through the pandemic. It was an extremely difficult time, but with the benefits of having good lenders, having good access to capital in the public markets, we were able to get through that period. But there are costs to being public, and public investors look at the world a little bit differently than real estate investors do, because real estate, we know, creates great value over long periods of time. It can create value in a short period of time, but in growing economies, it can create significant value over a long period of time. And so at different times in the cycle, you find that the public markets aren't valuing that long-term benefit of real estate as much. And so we saw that opportunity and were able to find private buyers to value the business higher than the public value was. And so we view whether you're using public capital, private equity capital, private credit, those are all kind of tools in your capital markets kind of toolbox on how you're going to run your real estate business. We consider ourselves hotel players, hotel owners and operators, but we may be public, we may be private, depending on where capital is flowing in the most efficient way. I hope that wasn't too complicated.
No, that's great. And I think the note he mentioned there, navigating through probably the most complex environments, right? And you had to pay your employees, but you also had to pay your mortgage. So, so it's amazing. So, so the pandemic was transformational in so many ways, but it created two darlings and that everybody wanted. And people shifted out of office, which we'll talk about in a minute, and they shifted out of other retail, they shifted out of, and they all went into industrial and apartments. And so Malcolm and Michael were beneficiaries of this enormous shift towards the multi-housing and industrial sectors and capital, et cetera. So, but things have changed a bit, rates are up, and Warren Buffett has a saying that when the tide goes out, you see who's swimming naked. And I believe, Malcolm, I'll start with you. Apparently, there aren't that many people
I'm
swimming
not getting naked. I don't care what you say.
Swimming naked industrial, but maybe tell us a little bit about how you see industrial evolving. And
Yeah, so like Manny said, we were one of the beneficiaries. And industrial benefited because everyone stayed home for the most part. Everyone ordered everything online. And companies needed, and you needed Amazon, and they did a lot of, they didn't go necessarily to Lincoln Road to Michael's stores or whatever, or to Terry's offices. But, industrial now became the darling for, everyone on this panel has the sexy stuff. Neil has sexy hotels, Michael has Lincoln Road, Terry has 830 Brickell, Edgardo, sexy condos, and we're just a box, right? So we
sexy
were
interest rates.
Yeah, sexy. No one ever likes Warren. Wait, don't. No, I'm just joking. So we became very, very, very important to the economy, and because of the nature of the business, we became in demand. So our business went from 300. I'm talking about the United States. We used to build 300, not us personally, but in the United States, all of us in the industrial world built 300 million square feet in a normal year. We went to 600 million square feet. So now we are back to 300 million square feet. So things have, just like you've seen, there's no more panic. Everything has normalized. But why industrial has done well, and why it's traditionally done well, although under the radar, is because it has a lower, when you have a warehouse, you don't have to put in additional capital. So Terry's probably the poster child office. The one knock against office is you get a tenant, the tenant leaves, and you have to potentially, move walls around and do this and do that. So in a warehouse, it's a box. They move out of the box, you move somebody in the box. Kind of similar like with Michael and apartments, except on a commercial. The other reason why, and like Warren said, we're in the best market in the country. So whether it's office or retail or apartments, for us warehouse people, and it's no secret, but of all the sectors here, and Manny will vouch for this, probably industrial has the safest future in South Florida, because you cannot go, you could, but typically you do not go vertical. So Edgardo and Terry and Michael, they could go vertical and create more and more floors and more inventory. When industrial, it's really just single floors for the most part. So we have, as we all know, a limited amount of land. So whether, again, we're building condos or office, we got the ocean on one side and we got the Everglades on the other side. And in Dade County, because we're in Dade County, there is still only, and it's going to sound like a lot, but it's not. We have maybe 1,000 acres left, 1,000 acres left of industrial land. This county uses 200 acres a year on industrial projects. So we have maybe 5 to 6 years left of industrial land. And industrial land, people don't typically want, warehouses next to them. So it's hard to get land rezoned, and you can't go up higher. So for us, we're very, very confident in Dade County. We have a number of large projects, and we think it's like a great area. So you got a lot of, we got a growing population, and we got a limited amount of land. So, if you do the math, supply and demand, we think it's going to be a great future.
And industrial has, and Warren can attest to this, some of the lowest debt in the country, right? So
Yeah.
default issues related to debt for industrial, almost insignificant.
Yeah, but and again, industrial generally is the most favored nation today, at least. But you go to areas like Atlanta or Dallas, it's not the same like Miami, because they don't have an ocean, they don't got the Everglades. They could keep going outside the perimeter, so they could create a lot more boxes. Dade County, you can't create many more boxes. And again, it's about distance and time. So yeah, you could go to Orlando, but to transport from Orlando and Miami to go back is long distance. Everyone wants something today. Amazon is all about immediacy, right? They have now Uber delivery. We're building in Fort Myers, a very big project. Amazon's going to start delivering refrigerators, mattresses. So this division that we're doing a building for is called an extra large division. So it's not just the toilet paper and the little things, and you're going to be seeing them delivering mattresses and refrigerators and televisions.
So when you're in the School of Architecture and you start drawing, you couldn't draw, but you could just draw little blocks.
I did. It's a funny story. I'm going to keep it short. But when I was in architecture, they said, you had to do a daycare center. So I created just a box. Here's a daycare center. There was a young man a very creative man from South America, and he had it look like a circus tent, and with kids and animals, and the professor loved it. So he got an A, I got like a C. I'm like, but who's going to build it that you can't afford to build a circus tent structure? He said, that's not the point. I went back to business.
Thanks, Malcolm. I'm going to come back to you in a minute, Michael, but I want to get to Michael Comras. So in 1998, the cover of Time magazine was the end of retail because of Yahoo online sales. During the pandemic, retail seemed to be bricks and mortar on its way to death as well. And today, retail is one of the strongest asset classes in the country. So.
Yeah, so it's so interesting. And when I first started with the advisory board, retail was probably the strongest of all of the different asset classes. And then over the years, we went down to the bottom. And then, of course, after the pandemic, we were really at the bottom. But what ended up happening is there was no new construction. And once the pandemic was done with, people wanted to go out. People wanted to shop. They wanted experiences. They wanted to get back to the restaurants. They wanted to get back to getting their lifestyles back in place. Today, there is very little vacancy in Miami. You can, as Malcolm was saying, he's talking about for industrial boxes, but for retail boxes, there are just none. They're not sitting around. Any boxes that come available are leased super quick. We just finished, we focus on all of the areas, including Coconut Grove and Midtown and Wynwood, Design District, and many of the areas here, they're all just doing great. There's a complete shortage of space, and rents are moving up. Even things here along South Dixie Highway, there's a property at 27th Avenue where most of you have seen the Dunkin' Donuts Pet Supermarket. We took rents over the last 3 years of $40 a foot and pushed them up to $90 a foot. So that's taking your NOI and just doubling it, and you haven't really done anything. I cleaned up the pylons, and I replaced a couple of tenants. But in Coconut Grove is another area where we just finished doing a project called Coco Walk. That was a 200,000 square foot retail center, and we modified it because what we saw was people wanted to have more of a mixed-use environment. We looked at Coconut Grove, which is surrounded by South Florida's best year-round demographics, and yet the village of Coconut Grove hadn't been touched in 25 years. Over the last 5 or 7 years, when we acquired Coco Walk, we tore down some unproductive space. We built a 100,000 square foot office building. And the whole idea was to make it a place where people wanted to live, work, and play. So today, if you're going in Coconut Grove, you have everything there that you want to have. It's a authentic, low-scale, pedestrian-friendly environment. It's close to Brickell. It has great restaurants. And we opened up the project 100% leased, both in the office and in the retail. Today, we're finishing our project right across the street, the former 24-Hour Fitness. We're converting what was retail into office space. You hear about office space around the country where you can't give it away. In Miami, it's quite the opposite. There's just a shortage. The demand in Miami, because of all the relocations and everybody who's moving down here. I was at an event the other night, and 5 out of the 6 people I was speaking to had all just moved here over the last 2 to 5 years. So I think the densification of Miami has really impacted the way that we are. And I always say densification really leads to localization. And we're really seeing a lot of that right now. People don't want to get in their car and travel. You guys all know what it's like getting in your car just trying to go to Brickell or trying to go to the beach or trying to go to Midtown or anywhere. It just takes too long. So we like the idea of creating a sense of place and going into these areas. We're working right now, we're just finishing up leasing in an area called Miami World Center. For those of you who aren't familiar with it, it's across the street from the arena. And it sits right in between the Bay and the new Bright Line train station. That's a 25-acre site and consists of several blocks. And what they did is the developers developed multiple buildings, both residential, hotel, condos, et cetera. And what they did is they created about 250,000 square feet of retail space in a plaza along 2 promenades. Right through COVID, we were able to actually lease almost all 200,000, we leased 200 out of 250,000 square feet. As of today, we have about a 5% vacancy. All tenants will be open presumably by the end of the year, and that includes tenants like Sephora, Lululemon, Lucky Strike, Container Store, LA Fitness, the Museum of Ice Cream, and some pretty exciting stuff. So we're seeing it all over. Design District is jamming. It's, it struggled through the pandemic, but then once the pandemic passed, it has just taken off, and it's probably one of the hottest retail markets in the country right now. So it's pretty exciting what's going on down here.
Yeah, it's truly amazing. By the way, I want to let you know how cool I am that yesterday I went to dinner at the Light Up. If you haven't seen it, Google it. It's super duper cool. Anyway.
How does that make you cool?
What's that?
How does that make you cool?
I was there. So, share my neighbor. Okay, so anyway, that's my coolness. I'll dress in black like you next time. So since you brought up office, let's go to Tere.
Okay.
And Tere, every day we read the newspaper and office is at the end of the world, et cetera, et cetera. But Miami's crushing it. Go ahead.
Yeah, is this on? Yeah. Yeah, Miami's crushing it, and we are an anomaly. We have clients that have portfolios of office all over the country, all over the world, and certainly the story in those markets is very different than what we're experiencing here. One of the most fascinating things that I get to do every day alongside with my team is work with developers that have a vision about what should be built and where should it be built. And so for us, it's important that, as Warren has suggested, we stay very connected to what is happening in a community. The demographics, the migration, the movement of people. Because when we can anticipate where that is going, we can anticipate where office and retail and everything else should follow. And so for me, when I look at office buildings, I look at a living organism that is going to be populated by all of you and a lot of colleagues and a lot of people that are going to show up every day, and we have to give them space, physical space, and an environment that they're excited to show up to work. And so the pandemic, as you have probably read, transformed office in many ways. One of the areas that we have been challenged with, even across South Florida, because I don't think the market is fully immune from it, is this whole hybrid work modality. And I was a firm believer in 2020 that it would be temporary, but it's lasted longer, of course. It has a long-lasting effect. And so that's caused many markets across the country to experience significant challenges with tenants that have not returned to the office, that have contracted, terminated leases, or have simply defaulted on their leases. Thankfully, over the last 2 years, more and more CEOs around the country are issuing mandates for everyone to come back to the office. And why? Because it makes it very inefficient and very challenging to run a business without having that face-to-face interaction. I will tell you that me personally watched my email triple in a year because people were not in the office. So I think by 2025, it is expected that we will be at the office at least 85% of the time, if not more. The contractions in Miami have been very insignificant, and whatever contraction we've had, we've backfilled like this because we have had tremendous migration of wealth and people during the pandemic and after, and it continues to trickle in. So that drives demand for office space from small businesses that want to be in Miami because they are feeding their businesses from the major companies that have decided to open regional offices here and from the relocations that are happening, and because they're following the workforce. People want to live here, and employers follow where the people want to live. So for us in office is about telling the story of why you should be here and creating an environment that people want to show up to work at. And in Miami, any new project that has gotten built over the last decade and even longer, we've done about 5 million square feet of new office developments, each time gets leased to 100% in record time. We've leased 1 million square feet of new office projects in the last 2 years in less than 24 months, from start to finish. So this is proof that when you build quality space in the right location, delivering the right vision for that corporate employer or that entrepreneur that wants to have an office here, and you provide all the right elements for that to be a place where people want to show up to work, we get at least, and we get at least typically at a pretty healthy premium. Rents in Miami have consistently grown over the last 4 years at a clip of about 7% annually, but there have been markets like Brickell, where you have the financial district, where rents have more than doubled in the last 3 years. Spectacular growth. This is driving some tenants out of Brickell, so for the first time we're seeing some vacancies in certain buildings in Brickell because not every tenant is ready to pay $100 a square foot or $120 a square foot. And so that's created some migration into markets like Aventura that now has the Brightline service, into Coral Gables, Miami Airport. And then there are markets that have zero office space, like Coconut Grove. Michael has a little project here that is going to be very successful because there's nothing else available, and it's beautiful what you've done. And he's going to really have incredible performance with that project. Perfect timing. So I'm still very bullish in office. The challenge is Warren and his colleagues and the banks will not finance any new office projects unless they are at least 60 to 65% pre-leased to credit companies, and that the sponsor is willing to put in a lot of their own cash and personal guarantees.
So you see, people will like me now.
Yeah.
Because I actually finance it. You see, you're wrong, Malcolm.
Exactly.
Everyone likes it.
Yeah.
Actually,
Yeah.
Warren's one of the easier lenders. Everyone, because right, Warren. I mean, you're a lot.
I'm very sloppy.
Yeah. Well, I'm going to come see you tomorrow. I have a few projects for you. But at the end of the day, what that translates into is constrained supply, so continued rent growth, continued absorption of any space that becomes available. And so if you're an owner office product in Miami today, you really are enjoying terrific performance, with one caveat. If you finance your project, let's say 4 years ago, and you're ready to do a recap, you need to refinance, and you need to go see Mr. Lender, you're upside down already, even if you're 100% leased and you have great rents, because interest rates are causing your valuation to be upside down. So we expect that this year, no matter what great asset you might have, If you need to refinance in the next 24 months or in the next 12 months at least, it's going to be a challenging situation for any office owner, no matter how great Miami is performing. So just call Acore.
Why don't we just give a contrast to that? Because, again, I'm trying to force your brains out of Miami. Take Portland, Oregon. Pre-pandemic, it was a city with the third highest in-migration of people under the age of 35. Fantastic demographic, very active, great city to be in, lots of job growth. We financed a building there, the most creative office building, beautiful, on the rail line, a Target on the ground floor, architecture firm on the top floor, incredibly beautiful. The borrower borrowed 65% of their cost, and the equity it was the biggest developer in Portland market, combined with a big private equity firm. Perfect sponsorship, perfect story. We're getting the building back, okay. They've decided they can't make it make sense, but it gets way worse. The Target just announced they're leaving. Why are they leaving? Because all that in-migration changed because of an uncontrollable, which was the change in the political environment. It moved completely left. So the policing is bad, the drug use is out of control, crime is through the roof. So Target decided to close the store. Now when does Target, it was on a 15-year lease, close the store? Because people going into the Target to shop were getting robbed. All we needed to do was to lease the 2 middle floors and take it from 70% occupancy to 90% occupancy, and the sponsor would have made a bunch of money, we would have been taken out. I'm taking it back at 65 cents on the dollar, and I think it's worth about 75 cents on my loan amount. So to give you a context, the office market in other markets, Los Angeles, San Francisco, Chicago, Washington, D.C., tough market, mid-block Manhattan, are having an incredibly difficult time. San Francisco, as an example, some buildings were selling for $1,000 a foot a couple of years ago, are now trading for $200 to $300 a foot. So if you want to be a contrarian and come out here and want to go and buy office buildings dirt cheap, there's an interesting opportunity for you there as well. But I'm just giving you the contrast to what's happening in some other markets.
And Warren, there's virtually no financing for office buildings.
There is no financing. If you're in any of those markets, there is no financing. And obviously in your company, you do billions a year, there is no financing.
Yeah, we used to.
I wanted to add one thing on with what Terry was talking about, and this is really, I have a daughter who's 23 in New York, and she just got a job at one of the major cosmetic companies. And she said to me, Dad, I don't understand. It's cold out, it's about to rain, and why does everyone have to go to the office? Like, I don't understand this, and this is such a COVID thing. And, to Terry's point of over the next several years, it goes back to 85%. I really love being in my office, having my team around me, and saying, hey, what about this? What about that? And if you're in your home, you're just not getting that. There's no collaboration. And you can Zoom all you want, but it's still not the same as being there and seeing and talking and just getting that interaction and the activity.
Yeah, definitely. So let me, today I was on a conference call with an Argentinian billionaire, which wasn't you, but no, just kidding. Who was, 5 years ago, was looking at buying a piece of land that our firm was selling, 10,000 square feet for $256 million to build a condominium. And today on a conference call, he was looking at a 600,000 square foot office building, very nice office building in New York City, 100% empty, buy it for $200 a foot, and convert most of it to luxury condominiums. So that's New York City. But in Miami, it is absolutely crazy what you guys are doing on the condominium side. Your buildings are getting to 100 stories. Your rents, your sales are $3,500 a foot, and it's just crazy. So tell us why it's so crazy.
Well, like I said earlier, I think that everybody wants to be in Miami. Of course, the combination of the people that we used to have, which are the foreign buyers that all were moving capital to the U.S., and of course they understood that buying in bricks and mortar was a safe bet, and that really they could be protected both and economically and socially. That demand was almost taken over by the U.S. demand. From New York, from Chicago, from LA, it seemed like every government in the world was confabulating to bring people to Miami because they really, all Latin America went left and California and New York, and between taxes and liberalism, it was really a serious problem. But there's one more factor that people realized when they came to live in Miami. Miami has an incredible lifestyle. Today, we're not selling an apartment. We're selling emotions, we're selling experience, we're selling human connections. I mean, I'm so fortunate to work with my wife, Ana Cristina, because she really, really understands how to make a building have a DNA, how the building have a soul, and how the people connect with each other to create experiences. Today, I mean, and it's true, and when what Michael was saying and what Tere was saying, the office building and the retail business, it's a lot more about the activity and the life of the asset more than the asset itself. And really, we can only provide it here in Miami because the conditions are here to be able to do so. And that's why the condo market turned into branding condominiums. And why? Because the Ritz-Carltons of this world, the St. Regis's of the Four Seasons, understand how to provide that lifestyle to the residential customer and the quality and attention to detail and the services and the food and beverage. That's everything that the new buyer is looking for, and that's why the condominium market is so strong. And in addition to that, the model of financing is great because we learned from the mistakes of 2008 when we were only asking for 10% or 20% deposits and the rest all from the bank. After the financial crisis, the model changed, and we're asking for installments, but 40 or 50% deposits from customers, and so the debt to cost ratio is very, very low. So the banks feel very comfortable in lending us money when you have 50 or 60% of the building pre-sold with 40 or 50% deposits, and the loan to value is 30 or 40% of the cost of the asset. So it really worked out very, very well. Obviously, the key component is how much demand versus supply there will be. And yesterday I was doing an analysis of the number of units that are coming in online in Miami, and it's between 10,000 and 12,000, which seems like a lot of condos. But in the heyday of 2008, there were over 30,000 units online to come up. So it's still, because of the difficulty in finding great sites, it's really more, the barrier of entry is more difficult. Both brokers and buyers are a lot more sophisticated, so they're not buying from inexperienced developers or people that don't have a track record. So it seems to be a very safe environment, even though I caution that, of course, we're in a great market in Miami, but I'm big. We kept saying, even in 2007, 2008, it's never going to impact Miami. Of course, when it rains hard, no matter how big your umbrella is, you get a little wet. So we need to be very disciplined and careful on what we do. But I think that, of course, we're in the greatest place in the U.S. and possibly one of the greatest places in the world. No?
So I'm going to move over to Michael here in a minute, but I want to ask you a question. During 2006, 2007, there were thousands of people speculating on condominiums. There were taxi drivers, hairdressers, et cetera, and they put 20% down. Today, I heard that you just sold out 60 units on a project here, and the average sale price was, correct me if I'm wrong, about $5 million?
$7.5.
I'm sorry, let's $2.5 million when it's friends.
Right.
So that means that someone to buy that unit has to put up a deposit of $3.75 million. So there must be some very rich taxi drivers out there, I guess, or
There's certainly no taxi drivers anymore, and really, again, the overall development community and the brokers themselves really learned from that experience, because it was painful, even though in our company we're probably the busiest we ever been when the banks took projects over, because of the vertical integration of having the knowledge and development and the marketing and sales experience and the network to be able to sell it in foreign countries. A lot of the banks hire us for the disposition of those assets and to clean up their balance sheets. But yes, we're in that specific project that you just mentioned. Not only we're not offering it to everybody, but we make the the buyer sign a non-disclosure agreement, the broker sign a non-disclosure agreement, show us proof of funds before we even give a presentation. So really, we're very, very careful on how to attack it. Of course, it's also a marketing technique of making it feel that they can't have it, so they want it even more. But really, it's incredible. I'm even very surprised that we have the amount of buyers that put that kind of money, and they continue to come.
Did Ken Griffin buy a bunch?
No, not really. I mean,
Okay, so thank you, Edgardo. So the largest asset class by capital, I believe, in the United States is apartments, which is Michael Sommers. And Michael, today to build an apartment is almost impossible. And I mentioned the thing about people swimming naked. There was a lot of people that were swimming naked that were buying apartments in the past 3 years, and now they're way underwater naked. So maybe, what do you, as your investment strategy now in this market today, tell us about?
So as a buyer, we've bought about 2,700 apartments across Miami the past decade, I think more than anybody else on earth. So we have a pretty good view into what's happening in the markets from a local demand perspective. So I think from the operation side, if you turned off CNBC, didn't think about the Fed, didn't think about what was going on, unfortunately, in Ukraine or in Israel, and you just thought about what was going on in the Miami market, rents are super stable and operations are good, meaning most properties in Miami are 95 to 96% occupied. I would say the same thing goes for Broward and Palm Beach counties. I would say the overall rent growth perspective has changed, where in 2021, 2022, we were getting about 20% rent growth on an annual basis. So rents today are about 40% higher than they were 2.5 years ago in Miami. So that's been a tremendous amount of growth that kind of pulled forward growth, and now we're at more of a point of stability. But I think the data that I focus is on the consumer at our properties and what is their real income. And I talk to other investors, and they seem to think, oh, Kendall must have incomes 15 miles from downtown Miami, probably an hour and 15 on the commute time. Those incomes now are $125,000 for households living in properties that were built 30 and 40 years ago. Those rents used to be $1,600. Now they're $2,400, $2,500. But it's not necessarily the same person living there, but the incomes used to be $60,000 or $70,000. So through inflation, wages are higher, and through in-migration, people can work from home some or have higher incomes, they're making more money. When I look at my peers in the space who may have gotten a little bit more aggressive on the leverage, we're typically between 50 and 70% leveraged. So we have good enough cushion and a lot of fixed rate debt that's still sub 4% interest we feel good about, some floating rate loans that are 8% that are thankfully still manageable because of the rent growth Florida's presented to us along the way during the business plans. I think the distress is going to be really on the fringes. I think most people are well enough capitalized, and the investors we have that are talking about selling, it's let's sell this for a 20% IRR over the last 4 years instead of getting a 30% IRR we could have had 18 months ago. And so there's still money on the table, but it's a matter of, do you want to ring the register now, or do you think things are going to pop back up quickly? I think I'm of the mindset that the Fed may cut rates 75 basis points this year, they may cut it 50. I don't think they're cutting it 150. So until I'm getting long-term 10-year fixed rate mortgages at 4.5% again, I think we're in a market where you still have to be pretty careful, and the guys that over-levered will have to sell, but there's so much capital of people have raised $500 million funds, $2 billion funds that want to play in the space still because they know the stability of the occupancy and the demand, that I don't see there being real steals. But I try to, throughout my career, find somebody else's mistake. And we've bought 4 properties the last 7 years. The day we bought them, these are properties of 150 to 400 apartments that had no website. When people think about what simple technology you don't need a Nest thermostat, you don't need a self-driving car, you simply need a website to advertise your apartment community. And those properties that you manage well, you can take care of day to day. You can fix what's broken and grow. I think the people who are having trouble, they're running out of money and they don't have money to put on a new roof. Well, if you have a roof that's been leaking for 2 years, over 770 apartments that I've been bidding for the last year, and the seller's still holding out for more money, their asset is physically deteriorating. And at some point, they're going to have to be a motivated buyer. The last thing I'll say is, what I've really learned in the past 6 months is how strong the American homeowner is. Because the American homeowner, for the most part, owns their house cash or owns their house with a mortgage between 3 and 4% interest. They may have bronze handcuffs, meaning they can't upgrade to a 5-bedroom house out of their 3-bedroom house because they don't want to give up their 3% interest rate mortgage and get a 7% mortgage. But as Manny said, about half of the apartment debt in America is going to roll in the next 5 years. And as wealthy as somebody's partners is, the 30% they put down, they're not ready to necessarily re-up at 7% mortgage rates. So there's going to be a lot more transaction activity. But when I went through the valley of the market in 2008, 2009, that wasn't when the properties were being sold. Real estate digests news and information very slowly and tries to work with lenders for a matter of a year or two. So it's really wasn't until 2011, 2012 that things were selling at good values with some volume in the market. So I think what you guys are going to be looking for in the next 6 months is still going to be a muted environment with still a big bid-ask spread between buyers and sellers. And I don't think the pipes are really going to be flowing until probably after the election.
I'm curious because I'm getting recently in the last 2 or 3 months 3 or 4 calls from developers that did multifamily. They're about to finish in the next 6 months, and they all want to exit as a condo conversion rather than, because obviously they can't get the caps that they were expecting to get. But what do you see? Are you? I mean, in some cases, and not peripheral assets, Wynwood, downtown Miami. So, what do you see that potentially happen, and why are they really want to exit now? And of course, if they can exit as condo, it's probably as profitable or better. I mean, we joke with one saying, "Oh, you can now sell it at 4.5 cap, and you won't sell it to me at 3 because it really works as a condo." But it's happening, so it must be something that they're seeing that they're afraid of potentially either having to refinance and getting the cost not under control in insurance and financing and the rents are not what they expected at the time that they pro forma it. No?
So I guess two sides of that. I think one is somebody quoted the number of, I think, 24,000 units or apartments or something under construction, whatever the number is. As Mr. Butters was saying, is that when you look at properties in South Florida, it's really the ocean of the Everglades. As little industrial land as there is, there's no single family land within 15 miles of downtown Miami. You have to bulldoze $1 million house to build a $6 million house on top of it. So the only housing opportunity coming into South Florida is from vertical construction for families to be able to live here. And I think philosophically, people need to get very much more used to living in a 1,300 square foot flat as a three bedrooms for a family, the same way a family might live in Berlin or Paris. I think so many people in America got spoiled by space. The sense that you could drive out of the suburbs and then come back to the city for work. As there's more and more densification in the suburbs, that commute time is only getting worse and worse. As for the condo conversion itself, I don't think with mortgage rates, it's really going to work as an investment versus rentals. I think truly rentals today are actually much cheaper than buying a property. So I think developers are going to try to explore their options to get out of things, but it's also going to be very hard if I ask Acore for a loan that says, finance my 300-unit apartment building, but every month I'm going to have 10 fewer apartments. There's going to be a point where you own 40% of the building. You're hoping all the other neighbors are paying their bills, but it's just a very messy transaction. We went through the other side of it last year in Phoenix, where we actually bought back the last 10% of a building to put together something that had been a failed condo and had to buy the rest of the buildings back to make it a more traditional apartment building that set us up for much better financing and a cap rate on the exit. So I think, but I'm shocked that there's sites selling to condo developers way ahead of what apartment developers would say. But those things haven't closed and they haven't gotten construction loans. So I really don't believe much is happening in the market until somebody has a construction loan and you know it's actually physically going up.
Warren?
Yeah, I just had one quick question for you, Michael, and maybe it's for the whole panel too, is obviously there's a lot of strength in the rental growth and the demand drivers in Florida. There's people that paid too much, sure, there's others that didn't. But the other factor is insurance, and the cost and availability insurance. Can you talk about the cost and availability insurance as a broad concept? And secondly, is the impact on valuation that you're seeing?
Absolutely. So just real insurance in general in the last 2 years has doubled the cost. We own suburban apartments in Kendall that we bought with insurance about $990 a unit per year. So to insure 264 apartments cost us a little over $250,000. That now costs us over $500,000 a year. There's a couple factors that went into that. One part of the increase is that as construction costs went up with inflation, we're asking our insurers to insure something that if it gets hit by a hurricane is now more expensive to rebuild. I actually think insurance doesn't worry me whatsoever on the apartment side because it's much, much worse on the home ownership side. I personally own 5 houses in Boca Raton, and I can tell you houses I bought 5 years ago with no impact windows, no new roof, I was insuring them at $4,500 a year. That house, to renew it this fall, was $11,000 with new windows and a new roof. So for the average homeowner who's saying, can I really afford 7% mortgage rates? Can they also really afford $900 or $1,000 a month in insurance, plus maybe $100,000 up front for a new windows and a new roof? That I actually think it's a barrier that's going to keep people in apartments longer. We have a great property in Plantation, Florida, suburb of Fort Lauderdale, that has 197 townhouses. Some of them are 3-bedroom townhouses with 2-car garages. That property has never done better because, to me, that was the last stop before homeownership. You move in, you get pregnant, you're maybe pregnant with your second kid, and you think about buying a house, but 1,400 square feet and a 2-car garage is enough space for you. That goal line of getting into a house is now so much more expensive than renting our townhouse for another year, even if the rent is $200 higher or 6% higher. So I think it's actually going to largely insulate the apartment industry, even though it will have a modest impact on valuation, $10,000 or $20,000 per unit, as long as it's not truly in a coastal flood zone, 3 feet above sea level. I don't think it's going to drive our business, especially for newer built stuff. I'm more worried about product in Tampa that's wood frame product that should have been built concrete today. In Miami, just to give you the history, in 1992, roofs blew off half of South Miami in Hurricane Andrew. The building code really, really changed thereafter. So the quality of product built down here the last 25 years is really excellent, and I think the insurance market, to some degree, is missing that piece of the quality that we have.
Yeah, I think, we just recently, again, we built concrete boxes. But to Michael's point, insurance has definitely doubled. And what we've done to mitigate it a little bit is we've actually upped our deductible. So typically, lenders would say, okay, you need a 5% deductible. By increasing the deductible, meaning what we would come out of pocket with if there was a hurricane, we're up to 20%. So we've been able to convince lenders now and banks to allow us to take a bigger risk, and then we're personally on the hook for it, of course. But we've been able to then, in my mind, again, I'm not in the same category as Michael and Edgardo and Tere and Michael. We're not on the water. We're a concrete box. Sometimes we're 5, 10, 15 miles inland. So and we're not very high, so the wind is not as great. So I'm willing to take that risk. So for us to mitigate that, we've now stepped up and we've worked, thankfully, with the lenders to reduce the cost somewhat. It's still gone up, though.
Just one other comment on that. I think in lodging, it's had a very big impact on the attractiveness of this market. Like California and Florida have had very significant increases in lodging. It's been more than double in a lot of cases. And all the insurers remember the damage because, we did have damage in 2017 and 2018 in other parts of the country. So I think that it was one of the, when you look at our portfolio, kind of, at least all of us Miami folks, we love the Miami portion of it. But I would say that was the hardest to get valued correctly in the marketplace among very sophisticated private equity owners that own a lot of assets, have the ability to kind of share risk across an even broader portfolio. But we're at a point in time right now that for certain parts of coastal Florida and certain parts of coastal California, there just isn't a great market. There's just not enough insurers willing to take that risk. That'll change, I would imagine, and I hope that our industry is able to the real estate industry is able to help that effort, and it will happen over time, but it has slowed down just interest in this market because it's an unknown right now.
Yeah, we're seeing in retail, we're seeing the insurance costs double, sometimes triple. The way our leases are structured are usually triple net leases, so basically the tenant picks up the expenses of the insurance, the real estate taxes, and the maintenance. For years, the tenants have always demanded a cap on the CAM, the controllable expenses. and the real estate taxes and the insurance have been able to float. It's my concern that over time now, given where these insurance costs are going, that the tenants are going to come back and say, hey, listen, I need a cap on my insurance. Why, I just can't afford to just keep paying more and more. I spoke to my lender because even though I don't pay the insurance, we pass that to the tenants. I said, well, listen, what if I was able to, why do I have to have that last 10%? They said, well, if you want to personally guarantee it, you don't need to do it. I'm like, wait a second, So, so it's really been a problem, and I don't, we're hopeful that it corrects, but our portfolio is primarily Miami-based, and we don't get any benefit of laying it off in other areas that are non-coastal.
Yeah.
And one thing just for the students to realize, we only buy insurance policies 1 year at a time. So you go out and get a 5 or 10 year fixed rate loan on your property to know what the cost of debt is going to be each year. Insurance is renewed every year. So you really cannot budget what your insurance rate in 2026 is whatsoever.
Yeah, as you can see, a discussion regarding something as mundane as insurance is a huge factor in our industry. So the real estate investment business has so many different facets to it: the debt markets, the capital, the leasing, the cost, insurance, et cetera. And I'll just bring one historical factor because none of you here were alive, but right after 9/11, there was a massive insurance issue in the United States, which was getting terrorism insurance. And it didn't matter if your property was in Miami or if it was in Texas or in New York City, it was almost impossible to get terrorism insurance, right? You remember that? So anyway, there's always a surprise, et cetera. But there's also a lot of good things, right? So with that, Andrea?
I wanted to ask if it's possible, are you willing to take a couple questions from students?
Absolutely.
Yeah, you're going to have to be brave, though, and walk up here and ask, because we don't have another microphone. Unless somebody's willing to spare a microphone. Come on up, don't be shy. Yeah, introduce yourself and what program you're in.
Hello. Hey, guys. First of all, thank you so much for the powerhouse talk. Yeah, thank you so much. I think I have 5 pages of notes from everything that you guys said, so truly, thank you so much. So my name is Gino Charaboto. I am a grad student for the Masters of Real Estate Development, and I was hoping you could talk a little bit more about your philosophy and how you choose where to invest. Imagine like a brand new lot, a brand new building, anything in general. What is your philosophy on, like, what metrics do you look at that helps you get the confidence that, yes, I want to move forward with this project here versus somewhere else? Thank you.
Yeah, sure. I guess the first, obviously, we have a lot of data on demand because of our sales organization, but if I can summarize, is where is a place that we can impact and improve the way people live. Really, that really is the trigger for us to. Of course, we love to have a waterfront property, but for instance, when during the pandemic, in the peak of the pandemic, we bought a site on Pompano Beach that had 2.5 acres on the ocean, and across the street 2.5 acres on the bay. And to be able to create 2 buildings, one with the beach in front and one with your boat on the backyard, was a no-brainer for us. I mean, and actually we took our children and drove by when nobody could get out of the house and to see the site. And when we showed them the site, I thought it was very expensive and sort of crazy to pull the trigger at the time. And they said, Papi, it's a no-brainer. We have to buy this. I mean, you have to buy this because people are going to want to live here. And it was Pompano Beach, which was sort of a sleepy town. So it was a challenge, but it's an example of things that we look for to be able to produce the product that people are going to want. I mean, we do have a lot of information through the salesperson in order to anticipate because the real estate, especially condo development, takes 3, 4, 5 years to complete. So not only you have to know what people want today, but what are they going to want in the future, and try to anticipate that and add technology to that and add lifestyle to that and add brand to that, as I was saying before.
I love the fact that your kids are your investment committee, which is very cool.
No, we're a very family-oriented type of business.
I have one thing I would say, go to regions that have positive population growth. So again, Florida, in general estate, because you'll get bailed out. If you make a mistake, people are moving in, and everyone here has product that, over time, higher growth. If you make a mistake, it will bail you out. Secondly, I think being local is very important. So if you're developing or buying stuff, you know your area, you know your neighborhoods. You start flying into different areas. You think you know it, but you don't always know it. And I think a lot of developers make that mistake.
I totally concur on that local nature. All the properties I own pretty much are here in Dade County. I know my market as best as anybody, and I can't, when people say, why don't you go to Nashville? Why aren't you in Austin? And I'm like, there's always a guy there like me who knows it better. And yeah, so we always look at, tenants and communities and where these tenants can do business, right? And what kind of rents can they pay? And they do a reverse pro forma. They say, we believe we can do this kind of volume out of the store. If that's the kind of volume we can do out of the store, we can only pay this kind of rent, so they can keep everything in check. But, we like to work in places where it does improve people's life, and it gives them a place where they can hang out with their families, their kids, and so on. And I think it's all about quality of life and creating places where people want to be.
I would just say I think you always need a hook or a story when you're going to get on the phone to pitch it to an investor or to a lender. I'll give you an example of the first deal we went and bought in Charlotte 3 years ago to grow the company into Charlotte. It was a 460-unit apartment community. Half it was built in the 1980s, half was built in the 1990s. Nothing about the buildings were that special. But I looked at it and I said, these 2 bedrooms are renting for $11.50 a month. This is within 15 minutes of an NFL, NBA city. There's only 3 other cities in America that have those sports teams that are possibly this cheap. And then there were 2 drivers of the property's location. One was it opened up to a 113-acre county park with walking trails, and there was literally a gateway, it was kind of rusty at the time, 50 yards away from the apartment buildings. I was like, oh my God, we're buying the property, and we have private access to this park that nobody else in the city is going to be able to walk into. The number 2 was Tesla could have been anywhere in Charlotte. It's a 2.5 million person metropolitan area, and there was only 1 Tesla location in the whole area. Tesla could obviously choose to rent in the nicest shopping mall they wanted, any corner of town. They chose to just be in a high traffic thoroughfare this property was on within half a mile of us. What Tesla was telling me was that we don't need to be in the best location. We need to be where everybody in the city can get to us in a 15 or 20-minute drive time. I said, well, if I'm trying to own a property where people are renting for $1,200 a month, trying to get to $1,500, I want them to go work at all those places with similar proximity. And so those 2 points got Hartford Insurance to, after 2 or 3 phone calls and a site visit, to say, we'll write a check and come in as your partner on the project.
So bottom line, be obsessed with your customer, right, I guess? That's not mine, Bezos said that. But anyway, any other questions? And
I don't think we can top that. You going to try? Look, there, come down here. The time is just flying. Some of these people have class.
everybody gets an A after this, just...
But it's not a real estate class. It's some other class.
Yeah, no, thank you. I'm very privileged to be here. I appreciate the opportunity of all you people. One question I have is, I was lucky enough in one of my marketing classes, I'm a marketing and business law major, so not technically real estate finance, but definitely have that interest. I've heard that 65, or in terms of people 65 and older, 11,000 individuals being the undergraduate population are turning 65 every single day. So I wanted to hear, in terms of investment opportunities, real estate, all that stuff, what you guys foresee, because we're having such a demographic situation that we haven't seen in a very long time, and I'd love to hear what you guys think is going to happen with that.
I'm only 35, so I'll let these guys answer. Who wants to take a crack at that one there?
Maybe I can get it started at least. I think, there's definitely, we've had at UM, we've had a visitor from Belmont Village, and there's some great assisted living facilities, continuing care communities, residential homes that kind of aim squarely at that market. So that's like one obvious way that that's real estate driven that you can see an impact. But I think that kind of the aging demographic, their healthiness for a longer period of time is something that even in the lodging business we think a lot about. And so we think about what is it that demographic is looking for. Often they want to travel with their families, like with their grandkids and their children. And so we're seeing in our hospitality business more suites, having more connecting rooms, having the ability when you make the booking that you can kind of pick that you're all going to be in one part of the hotel. So there's different ways that hospitality is kind of adapting to it. I would imagine in apartments also, the same kind of like adaptions are happening. I think some of the healthcare, like we've generally, so far, we've only had kind of wellness-oriented spas. But there is like another level of experience that you can extend outside of a hotel that kind of addresses some of the medical things, some of the other kinds of wellness kinds of areas that we're starting to explore, but we're not there yet.
Yeah, I was chatting, in fact, I think it was as recently as last week with someone who is in the healthcare business. And one of the strategies that they're implementing in the next couple of years is to build or acquire property where they can house 65 and older, so senior living or 70s, but have a continuum of services that support the lifestyle and their health and wellness. And so I think that, whether it's rental apartment projects or condominium projects or even in office buildings, I foresee that there's going to be a component in the common areas of any office project very soon where you're going to facilitate just medical checkups so that you don't have to get in the car or use mass transit to get to your doctor. Just some regular physical exams and quick check-ins, dedicating space for that to make it easier for employees and to be able to conduct their lifestyle in a place that offers all these services. And so the same thing for living. I will mention something. I had a presentation recently by Ron Book, who's the chair of the Homeless Trust in Miami, and we do a fantastic job in Miami for the last 30 years supporting the homeless population and making sure that we provide housing and that we provide services to them. We only have 809, well, we shouldn't have any, but we have 890 unhoused population here in Miami. In LA is 79,000. And across the country in cities similar to Miami-Dade County is 30 to 40,000. And the largest portion of that population is 65 and older. It's a real problem that the entire country has to address. And so I'll put that out there. It's a great question, a lot to be discussed in that regard.
Warren, are you financing?
Yeah, look, for us, when we look at it, those are great comments, absolutely. You should study longevity. It's a very important topic. It doesn't matter what you do, go study it, because it's very, very topical, and lots of good information about it. The other thing on real estate from a development perspective, think about the graying population is here. It's been an area where a lot of people have entered to develop. So you have independent living, so that's a modified apartment building and it's age restricted. So 55 plus, that's all that's allowed in there. You've got then assisted living, which is if you've got some sort of ailment or you have nursing facilities, not nursing facilities, but you've got nurses and so on to give you medication. That might be associated with an Alzheimer's center or some kind of other health-related facility. And then you have a thing called the continuing care retirement community, which has all three. It has independent living, it has assisted living, and it has a nursing facility in it. So effectively, you can go in there when you're 65, you can die, or your spouse dies, and you have a lot of friends around you. So one of the greatest killers of people over the age of 65 is actually loneliness. So what happens when you lose your spouse, you've been with that person for 50 years, you get really lonely. So there is a real place for any one of these areas of senior housing, and there is a growing population. Now the problems associated with it is, as you get deeper into the nursing care side, it is predicated upon the government Medicare and Medicaid. So these are kind of really sad places, nursing homes, and generally are operated by fairly shady people. It's attracted a shady population for some reason, not population, but developers. And there's a lot of crime in that space because they're arbitraging Medicare and Medicaid. So from my perspective, I stay away from Medicare and Medicaid because the government can change their mind and all of a sudden the property's upside down. And secondly, there's a lot of shady characters in that space, unfortunately. There is a tremendous opportunity if you want to be entrepreneurial and thoughtful to develop the area in the middle. But what is oftentimes forgotten is that it is a bunch of people whose lives every day are predicated on you servicing them. In the 90s, there was a lot of bankruptcies, and there are going to be a lot more bankruptcies now as a result of strategy drift. These are people who are developers that developed office buildings that said, oh, there's a bunch of old people, I'm going to go now develop a community. But what they forget is it's an operating business. And so if there's an elderly person there, they don't care how they operate it. If she doesn't get a medicine, she doesn't get a medicine. If you want to do it right, you've got to understand the operations of that business, be a really good operating partner, and combine that with real estate. And those are the people that are really going to win at the end of the day.
It's really like operating a hotel, right? The laborers trying to. The last thing I just mentioned real quick is medical office, healthcare. The highest employment growth in the United States is in healthcare, and there's tons of real estate opportunities in the healthcare space. So, with that,
Let's thank our panelists for. I want to thank all of you for coming and for staying, and I saw lots of people taking notes and things like that. The key that I think you want to take with you is, first of all, commercial real estate in Miami is fabulous. But secondly, commercial real estate is a place where you get to combine the operating part of running a business with the real estate capital part, where you have a very long-lived asset that can generate value for you for a long time. So where is a better place to study commercial real estate than here in the business school? And you guys are here. Thank you very much.
thank you. Good job.